All right, Tim, we had another wild week on Wall Street. Not only did the yield curve invert one more time, but we also had an interesting insight from the retailers with their earnings. What are you watching with the retailers?
Look, the retailers were fascinating because there's no doubt that the consumer is very healthy, but their earnings just drew such a dichotomy of reaction from investors. And I think what we came away with is, if you're a retailer and you have a lot of stores really close to a lot of the population, and you have an internet purchase strategy where people can either come pick up everything that they ordered right at the beginning of the store, not have to spend an hour walking through the store, or if you can deliver next day or better, then you're really a winner in this space. You saw Target up 20%. A couple after their earnings report. A week earlier, you saw Walmart have a really nice move. Internet commerce up 35% for the second quarter in a row. But on the other side of the spectrum is that if you look anything like a traditional department store, then you're on the endangered species list. Macy's was down 15% after their earnings. Kohl's, not necessarily down so much, but the stock had been down close to 50% in the last 2 to 3 months. So, the consumer is flush, but retail is a brutal space. And if you're not really on top of the strategy, you're going to get hurt.
Yeah, the consumer seems pretty strong. Now, last week, you mentioned that we might possibly be in a bond bubble. Do you have any more to say about that?
It really does feel more like we are in a bond bubble. That doesn't mean we've seen the absolute low in yields, but last week when we were talking, the 10-year was at 1.5%. Right now, it's at like 1.6%. There's still this occasional time periods where the 2-year edges a little bit up above the 10-year. That's this inversion that the media seems to be hyper-focused on. It hasn't stayed there for even an hour at a time yet, but it does cause waves of selling in the stock market. It was also very interesting that Germany issued earlier in the week 30-year bonds. They sold 800 million of them. Allegedly, they might have sold as much as 2 billion of them. They sold them at a negative yield of 11 basis points. I think that it would be very constructive if they were to sell 10-year notes also, which have more of a negative yield in Germany, because I think this negative yield environment that we have throughout a big part of Europe and in Germany, which is their largest economy, I think they want to make that go away. So if they sell 10 years, if that gets a tepid response, it would start to signal to investors that, hey, this negative yield stuff is kind of crazy. It's not really positive. It doesn't really encourage investment. Who would want to invest in an economy or a part of the world where interest rates are negative? And keep in mind that where they talk about there's 15 or 16 trillion dollars of debt that currently yields negative, that's all debt that's been outstanding, that's been pushed down to negative yielding rates because people feel that the ECB come September is just going to be forced to buy them and make the yields go even lower.
So Tim, before that, we're entering Labor Day weekend next week. What's the one thing you're watching?
Well, I think there's really a couple things we really have to watch. And one is what the Fed funds futures and the Eurodollar futures are going to start projecting about the Fed's meeting on September 18th. Right now, it's about a 50-50 split between the Fed cutting rates 25 basis points or 50 basis points. And this is kind of a shift for me, but I really think that there's a shift going on at the Fed. We got the Fed minutes yesterday, but that was 3 weeks ago. And in this environment, 3 weeks seems like a long time ago. I think the Fed is shifting toward a much more aggressive rate cut than some people have been anticipating. And if gun to my head, I would have to say they're probably going to cut rates 50 basis points from what I see.